In today's market update, I'm going to be taking a look at the price of gold. Today is the 18th of July 2019. My name is David Hickson, and I must ask you to please make sure that you have read and understood these disclaimers before we take a look at the markets. So here is an analysis of the price of gold. In the interest of keeping these market updates short, I'm going to present you only with my preferred analysis. I'm not going to present a whole lot of different options and waste time discussing them. The first thing that you'll notice, of course, is that the analysis is at the top of the chart instead of at the foot of the chart. That is because I believe that the price of gold is influenced by cycles that are synchronized at their peaks as opposed to being synchronized at their troughs. If you don't understand all that, please take a look at some of the videos that I will link to in the description, which discuss the whole concept of peaks as opposed to troughs and the different analyses that you can get. So let's take a look at this analysis and the important points. This is a monthly chart, so each one of these bars is 1 month, and we've got data going back to 1991, I think. And so here we have a 9-year peak, which occurred at the beginning of 1996. The next 9-year peak is over here. I think that's in 2004. And of course, the very big peak, also a 9-year peak according to this analysis, which occurred in 2011. So when we have 3 peaks in a row like that of the 9-year cycle, you would expect that we should be able to position the 18-year cycle peak there and there, and indeed we probably could, but there isn't really enough data for us to do that with absolute certainty. So those peaks aren't positioned on the charts, but it is almost a certainty that the peak here in September of 2011 was indeed an 18-year cycle peak. So that's the really big picture. Let's take a look and see what has been happening since 2011 and see what we're expecting to happen now. So because we're dealing with a peak analysis instead of the usual M-shaped cycles that we expect to see on our charts, we have to invert things. I call this an inverted analysis, and instead of getting the M shape, we expect to see a W shape. So the current 9-year cycle came down strongly into the end of 2015, and then it came up to this 54-month cycle peak over here. Then we had a bit of a triangular sort of a formation, or a 3-wave move down into this low over here in 2018, and now we are completing the W shape. Okay, so there's that W shape. It's a very badly drawn W, but I'm sure you get the idea. So what is happening at the moment is that price is moving up, as you can see, into this 9-year cycle peak over here. So now that is a nest of highs, and this is still a monthly chart, so it's quite a big picture depiction of the nest of highs. But there is something very interesting to observe, and that is that at the moment price is, according to this analysis, heading up into this 18-month cycle peak, and we'll take a look at a daily chart in a moment so we can see a bit more detail. But it's heading up into this 18-month cycle peak, and then this 9-year cycle peak is a fairly skew nest of highs that is occurring just after it. It's an interesting formation because you can see the 18 cycle peak is expected roughly within the next month or so. I think we'll check that when we take a look at the daily chart. And then the following 18-month cycle peak is expected after that, of course about 18 months later. But the 9-year cycle peak is pretty much exactly between them. So sometimes you will see this kind of situation occurring, and what it indicates is that the shorter cycles that have been found in the analysis have been slipping out of sync with the longer cycle, which of course we don't have very much information about. In fact, the last peak that was identified for the 9-year cycle was back in 2011. So ever since 2011, it would seem that those shorter cycles have been slipping and running slightly longer, and that is why you get this kind of situation developing. When this situation develops, where you have a longer cycle peak circle expected pretty much in between two of the shorter circles, which is the situation here, then we need to be on our toes, because it is quite possible that the shorter cycle analysis hasn't worked very well, and we could go back and we could look at these cycles and ask whether they really are peaks of the 18-year cycle, or could we perform a better analysis. But I'm not going to dwell on that too much at the moment, because it's not necessary for us to sweat too many of the details in terms of this bigger picture video. The important thing is that we're heading into an 18-month cycle peak. But we need to be aware that it is possible that this 9-year cycle peak is going to occur slightly early. It's a possibility. It's not a certainty by any means, but it's something we need to be aware of. So what is the analysis telling us that we should expect? Well, a very easy way of looking at that is to display the composite model line. There is the composite model line, which of course uses the information about the cycle analysis, recomposes that information to generate a line that indicates what would have happened if all that was influencing the market were these cycles as found in the analysis. And you can see the composite model line tells us to expect a peak fairly soon, pretty much within the next month or so, and then we're going to get a little bit of a dip down, but then the market is expected to come up to this 9-year cycle peak. Is that what is going to happen? Well, that is certainly a very likely outcome in terms of what's going to happen, but we must be aware of this 9-year cycle peak, which is floating in between these two 18-month cycle peaks, and it is also quite possible that in fact the peak that forms now, this 18-month cycle peak, actually turns out to be the longer 9-year cycle peak. It certainly is not impossible, in which case we need to be on our toes. So we need to watch for this peak, because it is also possible that the market will turn down at that point. So that's looking ahead a little bit. Let's now change to a daily chart, and let's take a look at the way in which the market is reaching up to the current peak. So I'm going to zoom in on this period of time over here. Now we can see a little bit more detail. Here is the nest of highs for this 18-month cycle peak, and you can see a similar thing happening here, where we have a nice orderly stack of circles in that nest of highs up to about the 20-week cycle. The 40-week cycle is a little bit displaced to the left, and the 18-month cycle is displaced to the right. That indicates that between those cycles recently there is some lack of clarity. The important thing is that we know that we're expecting a peak. And we must not ignore this 9-year cycle peak over here, which is expected at the moment in May of 2020. But when you're talking about a 9-year cycle peak, remember the last evidence we have for that peak was way back in 2011. So we need to give it a little bit of leeway. We are approaching that peak and we need to be aware of it. So you might be asking, is it possible that that peak that we're expecting, which is the 18-month cycle peak, is it possible that it occurred in June? Because we saw a peak in June, and since then the market has been fiddling around. It hasn't really moved very strongly. It is possible, but in my opinion it is unlikely, and the reason for that is because gold usually forms fairly nice sharp peaks. That's one reason, and this could certainly not be described as a sharp peak, because as I mentioned, price has been sort of fiddling around there. It hasn't dropped sharply from that peak. I would expect to see a sharp peak. That's an expectation, it's not an absolute rule. Another reason why I believe that we still have some upward movement ahead of us in terms of reaching that peak has to do with the FLDs. My favorite tool, of course, and here is the 40-day FLD, and you can see, if we take a look at this FLD, that price has recently come down to the FLD. In fact, let me zoom in a little bit more and we can really look at the detail of that, and you will see that price has come down, and on Thursday of last week touched the 40-day FLD, at which point it found definite support. It has since then been tracking along the FLD, by which I mean that the high of each bar is greater than the FLD and the low is below it. So you can see it's been tracking along that FLD all the way until yesterday. I have a little bit of price action that occurred in overnight trading. That's not a complete day. That's today's bar. It's not complete yet. So price has been tracking along that FLD. That kind of behavior is the sort of behavior that you would see in a G category interaction, where price comes back down to the FLD, finds support, and then we get an H category interaction for the final move up into this peak, which needs to be of at least 20-week magnitude, of course, because we're looking at the 40-day FLD. So I'm speaking there, of course, about the sequence of interactions between price and the FLD, which is a sequence that Hurst didn't define himself, but it's one that I've found very useful for trading these markets. And this kind of behavior is exactly what you would see in that G to H category interaction, indicating that we would expect some further upward movement for price to come up and reach this peak. So let's just speak for a moment about the FLD that we're looking at here. It's the 40-day FLD, and you will know that in recent market updates for the stock market, I've been looking at the 20-day FLD. So why am I not immediately pulling up the 20-day FLD? Well, when you're looking at the price interaction with an FLD, you need to understand what's happening in the bigger cycle picture. At the moment, the 20-day FLD is working very well in the stock markets, and that's because of the balance between the dominance or the amplitude of each of the different cycles. So something very interesting is happening here with the 20-day FLD, and there is that 20-day FLD, and you can see we are still getting some good, clear interactions, obvious support provided by the FLD, and so forth. In terms of tracking the interactions with this 20-day FLD, however, things are a little more difficult, and that's because the interactions, although they do exist and they can be identified, they are not as clear as we would normally expect. So why is that? It's because of what has happened to the amplitude of the 20-day cycle. So let me very quickly show you something. We can display the cycle lines for the cycles that we are tracking, which show us the amplitude, and in this case I'm looking at the 80-day cycle and the 20-day cycle. So if you are planning to work with the FLD trading strategy, you will know that the signal cycle is in most cases the 20-day cycle, and we have what's called the sequence cycle, which is the cycle over which the entire sequence takes place, which is a cycle of 3 degrees longer, and that is in this case the 80-day cycle. So you can see here are the cycles, and the level of the cycle above and below this white line gives us the relative amplitude of the cycle. And so there I've drawn the amplitude of the 80-day cycle. The 80-day cycle is beating fairly well. It's a little subdued if we look at it in terms of the longer cycles. We won't waste time doing that. But look at what's happened to the amplitude of the 20-day cycle. It was beating very nicely and regularly. During this period of time, the 20-day cycle would have worked very well as a signal cycle for trading on the basis of the FLD trading strategy. Here, the amplitude of the 20-week cycle increased, which would have been really good news if you were working with the FLD trading strategy. And in fact, if I display that FLD line just quickly for a moment, I think that you will see some of those interactions. Where we have strong amplitude, we have very good, clear interactions. But can you see what has happened to the 20-day amplitude recently? It has dwindled to almost nothing. And let me just clear all those lines and draw that over again. There's the 20-week amplitude. It is dwindling to almost nothing. When the amplitude of a cycle dwindles to nothing, you should not use it as your signal cycle. Okay, there isn't enough amplitude in that cycle for it really to work. As a matter of interest, what cycle could you have used? Well, you would look for a cycle that is demonstrating good amplitude, or has been demonstrating good amplitude recently. And here's the 10-day cycle, very nice strong amplitude. You could have been working with the 10-day cycle during this period of time, but of course you would probably need to start looking at some intraday charts if you wanted to do that. So let's now take a look at the bigger picture again, and let's consider methods we can use to determine at what level the current up move is likely to reach its target. Now remember, when price reaches a target, it doesn't mean that it is immediately going to turn down. What it means is that the cycle we use to generate the target has stopped influencing price in that direction, and therefore, of course, the market does become vulnerable for a turn, but it doesn't indicate an absolute level at which the market has to turn. It's an important thing to remember. So the way in which we can do this is by looking at our FLDs. So let's start doing that, and let's start with a really long FLD. We'll start with the 9-year FLD. So assuming that price dropped down out of a peak of 18-year magnitude, which, as I've already mentioned, is very likely, then this would of course be an E category interaction. Now, if you don't understand that, then revise some of the other videos in terms of the sequence of interactions. But if this is an 18-year cycle peak, let's draw a little triangle over there, then this would be an E category interaction, probably. In which case, this would of course be the F category interaction. So here we saw price dropping down and crossing below the 9-year cycle FLD. And here price has crossed back up above the 9-year cycle FLD. Now this was a really interesting and rather complex cross, and you'll see this kind of thing happening very often because FLDs are very powerful lines on your chart, and you'll often see price coming up to an FLD and then tracking along it, as it did here for a really long time. That's about 18 months that the gold price sort of pretty much tracked along that 9-year FLD, a really interesting period of time. However, there is a way of calculating the way, where price actually crossed the FLD, and this was explained by Hurst. And he said when you experience multiple price crosses of the FLD, you work out where the median price crosses the FLD, and it did it for the first time over here, and it did it for the second time over there. And then what you do is you calculate a central position. You basically average the level at which it crosses, and so we can generate a target from the trough over here to this level over here. And I've done the calculations, so I'm not going to waste our time by doing them again in front of you. The target for that move is, interestingly, $1,420, $1,420. Now you'll notice that the close for when my data ends, which was just a little earlier today after overnight trading, was 1421. So a really interesting thing has happened, and that is that price has just recently achieved the target that was generated by price crossing the 9-year FLD. So this brings me back to the point discussed earlier about how we are expecting this 9-year cycle peak. And the fact that it's achieved its target from crossing the FLD does not definitely mean that we've reached that peak, but it certainly indicates that the pressure of the 9-year cycle pushing upwards might have completed its mission, if you like. It's completed its task, it's completed its cycle. It might have. Price has been brought up to that level. It doesn't indicate it's about to turn, but it means that it's time for us to start looking out for this peak. Let's step down to the next FLD, which is the 54-month FLD. Now here we get some more interesting information. From this peak over here, price crossed below the FLD over there, which projected a target of 900. Now, as you probably know, price did not reach that target of 900. It in fact only reached a target of 1046. And so let me demonstrate something else that you can do with price crossing the FLD. When price fails to reach a target, you calculate the difference, which in this case was $146, between the target generated and the price that was actually reached. And you can then assume that the market has that amount of bullishness, if you like, which is coming from much longer cycles, and you can continue to adjust your targets using that number of 146. So let's take a look at the most recent price cross of the 54-month FLD, and we'll quickly go down to a daily chart for this. Here you can see price moving up, crossing the 54-month FLD, and if you read those numbers of the chart, you generate a target of 1330. That proved to be a fairly accurate target, with price just going up a little bit above the level of 1330 to form this peak over here, after which price came back down to the 54-month FLD and found support at the level of the 54-month FLD before it started moving further upwards. But what about that lingering bullishness that we have in the gold price? I mentioned an amount of 146, which was the amount by which it failed to reach its bearish target from the price cross of this same 54-month FLD. What you can do, and this is quite a fun thing to play around with when you're tracking price interacting with the FLDs, is you take this target and you add 146 and you get a new target of 1476. Now, I have found that secondary target, where you are including the consideration of the bullishness that has experienced recently, or the bearishness if that's the case, that target becomes an interesting target to watch. So far we have a target of 1420 on the 9-year cycle and a possible target of 1476 on the 54-month cycle. Let's take a look at our next FLD. Here we have our 18-month FLD, and from this same trough in August of last year, you can see price crossed up above the FLD at that point over there. It then came down and tracked along the FLD for some time and then crossed up above it again. We do the same thing and work out the average crossing level, and we generate a target of 1454. So that provides us with another interesting target in terms of where the price of gold is likely to go. And so in conclusion, the price of gold is still moving up towards an 18-month cycle peak, in my opinion. We need to be careful when price reaches that peak, because it's possible that the 9-year cycle peak will occur early. The price movement has fulfilled its minimum potential movement, and so we need to be on the lookout for that peak forming. I do hope that you found this market update interesting. Please let me know if you have any questions. Let us know in the comments under this video or send us an email. I look forward to hearing from you.